Well, tax time is upon us once again. Just in a couple of weeks, you'll be filing your federal and state tax returns and going through that whole process to get things ready to file. But it's also a good opportunity to take that tax return and understand what's on those lines, because there are some things you can do to help in terms of controlling the amount of tax you pay. Now, we've just come off this boom year in the markets, 2024. And what happens with boom years of the markets when you own mutual funds is many times there's capital gain distributions that occur that you can't control. So if the mutual fund manager has sold pieces of their mutual fund for a gain, that gain is going to be passed through to you, the investor, and then you are going to have to pay capital gains tax on that gain, whether you want to or not. So this is one of the major points that I would like to make here in this video is you don't have to go through that. So if you're involved in mutual funds that pay these large capital gain distributions in good years, there might be an option for you. There might be an alternative, and that is namely ETFs, which are exchange traded funds or index funds. The benefit of an index fund is they don't distribute capital gains. You're buying an index and that's it. Nothing changes with that index. So therefore, there's no capital gain distributions. The only time that you would pay capital gains is if we were to sell one of these holdings and trigger a capital gains. And sometimes we might want to do that to offset a loss or something like that. But the difference is you or we as advisors are in control of that process. So capital gains is an area that we would really encourage you to look at. The other piece of the tax return that you should look at too is dividends. How do dividends from your investments flow through to the tax return? Ordinary dividends, such as what's generated from taxable bonds or those kinds of things, or ordinary dividends from mutual funds or other stocks, they're taxed at ordinary tax rates. Whereas qualified dividends are a tax preference item, which means they're taxed at a lower rate, and in some cases taxed at a zero rate depending upon your income. So here again, dividends and how they flow through to the tax return can have either a positive or perhaps a very negative impact on the amount of total tax that you will pay. So just two items that we would encourage you to take a look at. There's more to the tax return than that, which we'll share some of those ideas as we go forward. But this is a good time to review where those line items are coming from and how can you make the tax return a little bit better and minimize the amount of tax that you